Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Affirm Holdings, Inc. quarterly report. Affirm Holdings, Inc. offers a range of businesses and services through its payment network platform. The company provides point-of-sale payment solutions for consumers, as well as merchant commerce solutions that cater to various industries. Its consumer-focused app enables users to pay for purchases over time. The company's active merchants include small businesses, large enterprises, direct-to-consumer brands, brick-and-mortar stores, and companies with an omnichannel presence. Affirm's platform supports a diverse range of industries such as sporting goods and outdoors, home and lifestyle, travel and ticketing, electronics, fashion and beauty, equipment and auto, and general merchandise. Overall, Affirm Holdings, Inc.'s services include consumer payment solutions, merchant commerce platforms, and partnerships with originating banks and capital markets partners. The stock price of Affirm Holdings, Inc. has remained relatively stable over the past year, with no significant changes exceeding -3.77%. While pinpointing specific news events that contributed to this stability is challenging, an analysis of recent earnings reports reveals some notable exceptions. Affirm's Q2 fiscal 2026 and Cone fiscal 2026 earnings reports resulted in stock movements that exceeded the -3.77% threshold. Despite announcing strong earnings, the company's stock experienced significant drops of approximately -4.41% and -7.77%, respectively. These events suggest that even positive news can sometimes lead to negative reactions. In general, minor corporate announcements, partnerships, analyst reiterations, or broader market movements often cause no significant changes in a company's stock price. Without precise daily price data and a comprehensive list of all news events, it is difficult to identify specific instances where a firm's stock price experienced such minor movements. Affirm Holdings, Inc. market capitalization of $20 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Affirm Holdings, Inc. holds a significant advantage in their industry. Affirm Holdings, Inc. trades at a higher price-to-earnings ratio of 86 times and a higher price-to-book ratio of 5.94 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 72% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for a company can be identified through various financial metrics. One key driver is merchant network revenue, which saw significant increases in both the 3 and 6 months ended December 31, 2025, with growth rates of 34% and 35%, respectively. Another important factor contributing to revenue growth is interest income, which rose by 21% in Q3 2025 compared to Q3 2024, and by 20% in HONE 2025 compared to HONE 2024. Additionally, the gain on sales of loans also experienced substantial growth, increasing by 48% in Q3 2025 and 61% in HONE 2025. Servicing income is another significant driver of revenue growth, with a notable increase of 49% over 3 months and 51% over 6 months due to higher servicing fee revenue. These factors collectively contributed to the company's revenue growth during the specified periods. The net income of a company underwent significant changes between 2024 and 2025. In the 6 months ended December 31, 2024, the company reported a net loss of $19.9 million, but this turned into a profit of $210.3 million in the same period of 2025, marking an impressive increase of 264%. This substantial growth can be attributed to various factors, including improved operational efficiency and strategic business decisions. In terms of quarterly changes, the company's net income showed a notable increase from September 30, 2024 to December 31, 2024, with a rise of $180,582. However, the most significant jump occurred between the 3 months ended September 30, 2025, and December 31, 2025, where the net income increased by $129.6 million, representing a staggering 61% growth. The profit margins also underwent changes during this period. The operating margin improved from -12% to 10% on a quarterly basis, while the net income margin rose from 11% to 4%. However, when comparing the 6 months ended December 31, 2024 and 2025, the profit margin decreased by $1,398,000. This decrease can be attributed to various factors, including increased competition and market fluctuations. Overall, the company's net income and profit margins showed significant changes between 2024 and 2025. While the net income experienced a substantial increase, the profit margins underwent mixed results, with some improvements and decreases. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. The data shows that the net cash provided by operating activities has increased from $508,884 in 2024 to $548,310 in 2025. This increase suggests that the company is becoming more efficient in managing its day-to-day activities and generating revenue. The positive trend in operating cash flow is a crucial indicator of a company's financial health. It implies that the business is capable of covering its expenses and investing in growth initiatives without relying on external funding. The significant jump in net cash provided by operating activities from 2024 to 2025 further reinforces this notion, indicating a strong foundation for future growth and expansion. The company's debt level has undergone significant changes over the past few years. Total debt has increased from $8,085,919 to $12,473,780, with secured debt rising from $7,913,776 to $12,143,780. Conversely, unsecured debt has decreased from $1,141,321 to $330,000. Funding debt has also seen a substantial increase, jumping from $757,188 in 2027 to $9,009,240 in 2028. In terms of interest expenses, there is no clear indication of a significant change in total interest expenses. However, accrued interest payable has increased from $1,894,000 to $5,054,000, and amortization of debt issuance costs has risen from $12,990,000 to $14,072,000. Notably, interest expenses related to convertible notes have decreased significantly, with a 100% reduction in the 3 months ended December 31, 2025, and a 98% reduction in the 6 months ended December 31, 2025. Management is optimistic about the company's outlook and strategy. They are focused on building a next-generation payment network using modern technology and strong engineering talent. This will enable the company to stay ahead in the market and provide better services to its customers. In terms of revenue, management expects it to decline as a percentage of gross merchandise volume, GMV, due to an increase in low average order value transactions. However, this is seen as a medium-term issue, and the company is working on optimizing underwriting and managing consumer loan repayment to minimize losses. The company has experienced strong growth in GMV, with a 36% and 38% increase for the 3 and 6 months ended December 31, 2025, respectively. Management aims to amplify network value by increasing consumer engagement and repeat usage. Overall, management's strategy is focused on building a robust payment network that provides value to customers while minimizing losses. The company's business model does not rely on generating material returns from its investment portfolio, but rather on providing innovative services to its users. The company has made several significant acquisitions and divestitures in recent years. In terms of acquisitions, the company has purchased loans from originating bank partners totaling over $50 billion in a span of 2 years. This includes $10.8 billion in loans for the 3 months ended December 31, 2025, and $19.5 billion in loans for the 6 months ended December 31, 2025. Additionally, the company has acquired loans worth $8.1 billion for the 3 months ended December 31, 2024, and $14.5 billion for the 6 months ended December 31, 2024. The company also purchased all loans facilitated through its platform and originated by originating bank partners. This acquisition is a significant one, as it allows the company to expand its portfolio and increase its revenue streams. On the other hand, the company has made some divestitures in recent years. One notable example is the repurchase of $1 million and $27.4 million aggregate principal amount of 2026 notes under the May 2025 authorization. This move suggests that the company is actively managing its debt and liabilities to optimize its financial performance. The company's financial history reveals a commitment to shareholder value through dividend payments. This decision demonstrates a focus on rewarding investors for their loyalty and trust in the company's growth prospects. By distributing profits as dividends, the company acknowledges its responsibility to allocate excess funds effectively, thereby enhancing investor returns. Concerns have been raised regarding the accumulation of inventory and potential disruptions to the supply chain. An analysis of warehouse credit facilities and securitizations reveals a notable increase in assets and liabilities between June 30, 2025, and December 31, 2025. This trend suggests that companies may be stockpiling inventory or experiencing difficulties in managing their supply chains, which could have significant implications for the overall efficiency and resilience of the logistics system. That concludes the financial summary for Affirm Holdings, Inc. Feel free to comment below, and I will be happy to answer them when possible.